My name is Andrew Stotz, and I'm going to walk you through some of my latest strategy for the all-weather strategy. And basically, I'm going to walk you through a few presentation slides. Before we get started on this, maybe I'll just tell you a little bit about me. For those people that don't know, I've been studying, teaching, and working in finance, as well as investing for 35 years. I'm old. The second thing about me that's interesting, I think, is that after 300 interviews on my podcast about investment loss, it's really helped me focus on how to reduce risk. And I think that's a lot of the theme that you're going to get to see today about reducing risk. Oh, and one other thing about me. I live in Bangkok with my mom, and there she is. That was Christmas time. So there's 4 topics that I'm going to cover, and I'm going to take your questions and answers. I've already got a lot of questions that have come in, but feel free to bring in any questions you may have. So first thing I'm going to talk about is the strategy and the methodology of the all-weather strategy. Keep in mind that I provide this strategy to Phenomena, and then Phenomena is able to help their clients to execute this strategy. Hopefully you're doing that. Now, just want to remind you that you can ask questions right now at any time by leaving a question in the chat. I'd love to get your questions about anything, about the markets, about the US, about global. So first, let's get started with the methodology and objective of what I do. And really, if you come to know about me, it's FVMR methodology. So if you look at this diagram, you see that management is at the top, they're responsible for earnings, and investors are at the bottom, they're responsible for price. And I look at 4 things every time that I look at stocks, and that is fundamentals, and really that's about the profitability, and it's the responsibility of management, and it's the earnings. I also look at the valuation. Of course, I want to find cheap stocks that have good fundamentals. This has to do with the price in the market. And then the third one is M of the FVMR, and that's momentum. Of course, we're looking for assets and stocks that have both earnings momentum and price momentum. And finally is risk, and risk is really probably the most critical aspect. I prefer, of course, low business risk, and that has to do with the earnings of the company, and then price risk has to do with the volatility of the stock. So hopefully you will be able to remember FVMR, that is the framework I use. Now, what's the objective of the all-weather strategy? If you're already positioned in this strategy, I want to just reiterate it, but if you're new to this strategy, the objective really is 2 things. First, to try to capture as much of the global equity market long-term growth. We know that stock markets grow over the long term, so we want to capture that. And then the second one is to try to blend in different asset classes to try to protect the downside. So equity is really the core, and all the other asset classes are trying to protect the downside. What that means really is that I don't try to invest in, for instance, bonds or gold because I think, oh, that's going to fly. I'm using bonds and gold as a tool to protect me when the equity market goes down. So what is my goal for you as an investor? My goal is to provide investors a strategy that reduces the time they need to spend on managing their money. That's the simple part. After 35 years of doing this, I think I can help with that area. Last thing is the 3 drivers of this strategy. We like to call it GLD. First, it's global. Second, it's long-term. And third, it's diversified. Let's look at that for just a little bit more. First, we talk about global. This is an investment strategy that invests around the world, not just in Thailand. So many people already have their weights in Thailand. This gives you global exposure. Long-term, well, that gain, the portfolio will gain from long-term return while trying to reduce the portion of losses during, equity market downturns. And then finally is diversified. Really, there's 4 main asset classes: equity, bonds, gold, and commodities. And those are the main ones that we look at. And let's talk about the performance so that you understand how this has worked. We started 2020 with a 65% weight in equity, 25% gold. It was pretty high, actually, in gold. Then we moved in March down to 25 equity as things started collapsing as a result of COVID. We instead switched most of that money into bonds. And then after that, we started to reduce, by June, we started to reduce the bond exposure, increase the equity exposure, and then over time, we continued to increase the equity exposure up to 50%, and commodities ended up getting 5%. And finally, right now, if you're following this strategy, right now we are basically heavily weighted in equity. Now remember that it is a long-term strategy, though I reevaluate it every 3 months. And the end result is that this can change, but right now we're riding the wave of the equity rise. Now when I say 85% equity, I'm not actually showing you yet what is the components of that equity, but I can tell you it's mainly emerging markets and that the US is underweight in our equity weighting. And we'll get into that in just a minute. Remember, if you have any questions along the way, feel free to put them into the chat. So, our defensive positioning, meaning bonds and gold, captured less of the 2020 equity upside. This is the performance of the AWS strategy. And you can see, the one thing you can see about the AWS strategy is that it's going up. The second thing is that it has a smaller amount of volatility to it. And that's because of the blending in of the different asset classes. But we missed some of that upside this year because we were defensive when it came to equity. Now we've increased that and gotten a little bit more aggressive. That may change over time. But the objective really is also to protect on the downside. So let's look at the downside and see what it looks like in this case. This chart basically is looking at different days of the year. So we can see the 12th of March was the biggest fall in the overall equity markets, the MSCI World, meaning all global stocks. It fell by 9.5, but the all-weather portfolio fell by 4.3. That's exactly what we're trying to do with this strategy, is protect the downside. We know we're going to miss some of the upside, but the idea is to keep this growing as best we can over time. In fact, what you can see is that all of the major market drops, our portfolio tends to drop less, and that's because we're blending in the other asset classes. So, I just want to reiterate the key points of what I've just introduced to you and the bottom line. So, what I talked to you about was that in September and November, gold price began to fall, even though uncertainty remained in the markets, and we started to reduce the portfolio's gold holding. Overall, that high allocation to gold in 2020 was positive for our performance, but we had a lower equity allocation, so we underperformed by a little bit on the equity side and on the overall portfolio. But ultimately, we thought that 2020 was a year of massive risk, so we just wanted to protect the downside. So again, the all-weather strategy aims to cushion the downside relative to just a pure equity-only strategy. All right. Let's look at the next topic that I want to raise with you, and that is the idea of protecting against the U.S. market risk and U.S. dollar downside. Now, I've already got a question that came in about, am I nervous about the U.S. market? Yes, I am worried to some extent, and I'm even more worried about the U.S. dollar. So let's take a look at that for a moment. And here you can see a little bit about the election. This guy, Dr. Robert Epstein, is not a Trump supporter. In fact, he voted for Hillary, but he does a thing where he tries to estimate to what extent the big tech companies may have an influence on the election. And he had a big conclusion, which was 15 million votes could be shifted. And after the election, he claimed that about 6 million votes went to Biden thanks to the support of the tech companies. Now, how they do this is very fascinating, and really it has to do with nudging people to go vote and also controlling the narrative that goes out to people. The reason why I tell you this is that basically it's a key point as to how Biden was able to grab the presidency with the support of the tech companies. And right now we've seen the tech companies even ban Trump. So you can see that they're biased against Trump. And, you know, he's not like the friendliest, nicest guy out there. I think most people would say, you know, who wants to back Trump because he's such a wild card. But I just want to show you that the first thing on this chart is that I looked at the profits of 5,000 companies in the US to make this table. And I saw that 15% of the profits of 5,000 companies comes from 6 tech companies in America. Facebook, Amazon, and the like. That's crazy. That's a super, super high level of of profit, and I would argue is probably enough to say there's a monopoly in the tech companies. Now, we got a lot of questions coming in. Please keep them coming in. And now let's talk about the tech companies just for a moment, because I know many of you have asked me the question, like, why not overweight tech or keep going with tech? I'm very nervous about where the tech companies are, and I think they're vulnerable from political sense. Remember that Trump tried to send the regulators after them, and he's trying to fight back against the tech companies, saying that they're biased against conservative voices. Now, there was pressure from Republicans, and also even Democrats previously talked about splitting up the big tech companies. But the last bullet on this slide basically tells you that I expect that pressure will subside under Biden, meaning they're not going to put too much pressure on the tech companies, because the tech companies were very helpful in this past election. So I just want to talk now and switch the focus a little bit away from tech. So my conclusion on tech is that if you own tech, probably don't go overweight tech, go neutral weight tech, and you may even consider in the next couple of months trimming, because eventually the Democrats will come after the tech companies. But for right now, they're letting it ride. Now, I just want to talk about, in 2008, I was here in Bangkok. In fact, I've been in Bangkok since 1992. But in 2008, we had the global financial crisis. And at that time, the US government used it as an opportunity to take over the global financial system. So I now call it the US global financial system. And what do we see? We see that 90% of global international trade is in dollars, 40% of global debt is in dollars, and 60% of global reserves is in dollars. But that's not the takeover that I'm talking about. That's just natural that there's a lot of transactions that are being done in dollars. What takeover I'm talking about is their ability to control what happens in the financial system. The US government wants the world to keep using dollars. It's trouble if they lose that. Now, since almost all trade is made in US dollars, this allows the US government to have the unique ability to cut any person or company out of the global financial system. And we saw Barack Obama originally do this with Russia, and it really came down hard on the country, the companies, politicians, individuals. They used this new power that they gathered after the 2008 crisis. And I would say this is a dangerous power. Now, here is an Office of Foreign Asset Control document that you can get from the internet. And basically, there's 1,500 pages of people who are sanctioned. And this is the word that they use, sanctioned, to block someone from participating. And I'm telling you, if you have a business where you're exporting, importing, doing any transaction outside of your home country, it's going to be in dollars. And if they can stop you from that transaction, you're dead. And here, if you go to this document, as I did, and I typed in the word Thailand with quotes around it, I came up with 1,126 references. Now, some of those are repetitive, so I would estimate about 300 Thai people are on this list. You've been sanctioned. Maybe it's you. Maybe it's your uncle, your cousin, your father, your friend, your mother, someone. People are being sanctioned by the US government, and I think the US government will continue to use this power. And this is a threat to the US dollar. This is a threat if they overplay this power. Now, countries are searching for alternatives. You remember that Trump did sanctions on Iran in 2018, and the other European countries didn't like it. So that pushed France, Germany, and the United Kingdom to begin to develop an alternative dollar-free system to continue trading with Iran. And now Russia and China have reduced the use of the dollar in their trade between them. Now, with the Biden administration coming in, I think they're going to try to come off of some of these pressures, but they're still going to want to hold on to the dollar. Now, here you can see, I was on the website of the Central Bank of Russia, and I was just looking at their currency reserves. The bar on the left is 2018 March, and then 2019 March. And I'll just highlight this with an arrow to show you the amount of US dollar foreign reserves at Russia. They have cut in half, and instead they've increased it to euro dollar assets as well as gold assets. So we can see that Russia in particular is reducing its exposure to the US dollar. Now, the world wants an alternative to the US dollar, and the US will resist that with force if necessary. In fact, one of my sad predictions is I think in the next couple of years we're going to see war. And I'm a little bit nervous about this, but one of the hallmarks, one of the odd things about Trump is that he never started a war. Almost every president before started one. Eventually, what's going to happen is we're going to see a shaking of the foundation of the dollar. The dollar's already falling. Why is it important if the dollar is falling? Well, we have to be careful not to own too many dollar assets. But for now, the dollar is supported by high demand for trade and debt repayment. There's no way getting out of the US dollar right now into any other currencies. There's no other reserve currency ready to take up the slack. Also, in times of uncertainty, there tends to be a shift to dollars. In fact, I would expect that the US government could even destabilize parts of the world, like the Middle East, as a way of keeping the dollar strong. A strong dollar means, of course, US imports are cheaper. That helps with inflation in the US, and US exports are more expensive, right? Now, my conclusion is this. It's likely that we're going to see short-term US dollar strength because there's a squeeze on euro dollars, and also I believe that the Democrats now would potentially destabilize some parts of the world, not because they necessarily want to do that, but because they are naturally probably more interventionist than, let's say, Trump. And I expect, though, a long-term dollar decline. And this will reduce the power of the US dollar on the global stage, so they'll naturally resist it. And here is a chart that I made that just shows the dollar's decline from 1971, when the dollar came off of the gold standard, till today. And you can see, of course, we've got a lot of ups and downs over that time, but the trend is down, and I expect that that trend will continue. So what are my key points and the bottom line? Well, first, the US government will use hot and cold war to force, use that force against others to maintain dollar dominance. US government will increase global and domestic surveillance using private companies like big tech to suppress opposition, either to the dollar or other political opposition. It's been amazing to see some of the opposition leaders as well as government leaders in Europe saying that it's setting a bad precedent by the tech companies censoring or banning Donald Trump from being on their platform. Because we know that in many countries around the world, in fact, think about it. Who wouldn't like to see their opponent banned? I don't think anybody would not like that. But the truth is, if you want true democracy, if you want true exchange of ideas, you want to not have that. There was a saying when I was young, and that was, I don't agree with your opinion, but I would fight to the death for you to have the right to say it. And that's a famous one in the US. So the world is searching for an alternative to the US dollar, but the US government will fight to the death to maintain it. So what is the bottom line? Global trade disruptions are likely to intensify. I expect an ugly fight for power and a long-term dollar decline. All right, now let's talk about the outlook going forward. What do I see? First, remember that we've raised the equity allocation to 85%, and that was coming up from 50. So we really are trying to ride the wave of the vaccine, the election, all of the different things that are happening. And we're reducing the weighting in bonds down to 5 and gold to 5. So my point is, with Biden coming in, we should expect more stimulus. And I expect that he's going to, and his team is going to bring a lot to the market. Keeping in mind also that COVID vaccines are driving positive sentiment, and even though Europe is restricting and going down and shutting down, the point is that with vaccines coming on, people will be more positive. So also we can see that news is getting priced into the market, so it may not go up forever when it comes to the vaccine news. And of course, there is a major risk that if something went wrong with the vaccine, that the market would be at risk. And that's part of the reason why we never completely get out of bonds, completely get out of gold, because we want to have some protection there. But truly, bonds are less interesting as a yielding asset. Now, remember, we're holding our bonds not to make a big gain in bonds, but for the diversification benefit and the downside protection. as interest rates are low worldwide, there's less opportunities to earn a return from bonds. It's an amazing chart when you look at the bond interest rates over the last 40 years. We have literally been in a fall for 40 years until we have interest rates almost at zero. Remember that falling interest rates mean rising bond prices, and therefore we've had a 40-year rally in bonds. And my call is that that's probably over. Also, strong equity and low rates just make bonds less attractive. So that's part of the reason why we've got bonds down to 5%. Now, also remember that we now have what would be called a risk on, where more positive news about the vaccine is driving the market, stimulus packages, and remember, with Janet Yellen in place as Treasury Secretary, it's possible that we could see the Fed pumping money into the market where they actually buy funds that buy shares. So we revise our strategy for the all-weather strategy 4 times a year. Our next positioning or repositioning is in the next couple of months. So we're holding this position at 85% equity for right now. And so hopefully you're seeing this portfolio through phenomena, and if you're not, ask them how you can get access to it. So let's now just look briefly to remind ourselves, 85% is the equity allocation as of December. We've got all other asset classes down to 5. So let's take some questions. I saw a question that came in. It says, what's your view on the Chinese market? Well, basically, much of Asia has seen COVID outbreaks, but a lot has passed, and I would say we're more towards recovery in Asia. And also, China has seen a strong demand recovery, which is positive for Asia. So my general perception is that Asia is going to have a strong year ahead of underlying growth and also of the market, right? And so remember that China is a major driver of the emerging markets. I was just looking at this chart of China right here, and you can see that it's been one of the best performing markets. It's performing very well. So I would say, if you ask me about the Chinese market, it's going to be a pretty good year. Of course, the market's already run a bit, so be careful. Don't put all of your money in there, but I think it's interesting. Now, another question that I got is, what's your view on European economy and its weight in the portfolio? Well, as I say, let the stimulus checks reign in Europe as well. EU is launching stimulus, and though previous attempts have really had mild impacts, but there's some new motivation. They're talking about printing money to support the green initiative, environment, and all that. So I would say a no-deal Brexit and relatively high exposure to financials in the current low interest rate market makes us keep the weight of Europe down at 5% within the equity. Now remember, I've talked to you about 4 asset classes: equity, bonds, gold, and commodities. Equity is 85%. So now we're going to break down that equity to say, well, where have I allocated that 85%? And here is the allocation of that 85%. And what you can see is that the US is 25, Asia Pacific is 25, and emerging markets are 25. The rest are at 5. So you can see we're underweight the developed markets. We're also underweight the US because that's normally a very large component here. So that's part of it, is that though we've increased our equity weighting to 85%, most of that's going into Asia Pacific and emerging markets. So, and problems are far from resolved, right? Remember, US remains overvalued. The US government debt is growing every day. And even when COVID is under control, there's also many other issues of global geopolitical tensions, which I think are very dangerous right now, that could lead us to a disruptive situation. And then mass unemployment. I mean, the unemployment numbers are crazy, right? They're crazy. And so we have this max allocation at 85% in equity, but we'll reconsider that in the next 3 months. So what are my key points and my bottom line? Well, President Biden, stimulus checks, and vaccine news lead to short-term positive sentiment. We increase our equity allocation to the strategy to 85, which is our maximum, though we're underweight the US. And we'll reconsider this in less than 3 months. So the bottom line is raise equity allocations, underweight US, favor Asia, and reduce gold. So we've got some other questions that have been coming in, and so I'm going to switch now to start answering some questions. So I do have some questions that have been asked, so let me just look at one of the questions that just came in. What do you think about esport industry and the esport ESPO ETF? I think esports is interesting, and there's a lot of, obviously, a lot of stuff is going online, and so there's usually a lot more opportunity in that space. I have not looked at this particular ETF, so I can't say that I can give you a very strong opinion about this particular ETF, but what I can say is be very careful because we do have a extremely, strong market in some of these spaces, and what can happen. Take a look at what's happened with Zoom recently. Zoom, the video conferencing stock, has gone up, massively during this crisis, and what happened? Just recently they announced a capital raising. And sometimes what you can see is a very strong share price performance and then a dilution through capital raising. And if that happens, then you could be struggling in that ETF. So just, if you like that esport ETF, go ahead and go into it. But I would say just don't make it a large portion of your overall portfolio. Now, your outlook on the Vietnamese market and the ASEAN market. First thing is, the problem that I face with Vietnamese market is that the amount of volume there is so small that there's only a small number of companies that really are liquid enough to get in and out easily. In fact, I had a Vietnamese friend of mine on my podcast, and she lost a lot of money as a Vietnamese person investing in illiquid Vietnamese stocks. And when it came time to get out of it, she couldn't get out of it. So I just want to mention that with Vietnam, you've probably got about 20 companies that really are something that you can get in and out of. And I would say generally, I think Vietnam has a lot of growth, but I wouldn't take a strong position right now in Vietnam because I haven't really spent that much time because it just doesn't have enough companies. Think about Thailand. Thailand has about 130, 150 companies that are more liquid than just 20 companies in Vietnam. And the ASEAN market, now this is what I think is really interesting about ASEAN. If you do a correlation between the US market and the European market as an example, you'll find that they're pretty well correlated. But if you do, a correlation between, let's say, the US market and Hong Kong or Taiwan or Korea or Singapore, where the dollar is linked in many of these cases and the countries are interlinked, you find that the correlation of these markets is pretty high. That means if the US is going to fall, these markets are going to also fall almost equally. But ASEAN is really the only economic area in the world that does not have a high correlation to the US market. Therefore, ASEAN market can be a defensive play for those that want to own equity. So it's very possible that you'll see fund managers from around the world taking a position in ASEAN because of the lower correlation with the US market. So that's the first thing. The second thing about ASEAN is that I would say ASEAN's not that expensive, in my opinion, and we have a lot of inherent growth for the next 10 years as educations rise, as population grows. Now, Thailand population growth is very small, but overall in ASEAN, I think there's an inherent growth. All right, so let's see, what's another one here? That one is, so what is your investment perspective in Vietnam and Indian market from 2021 to 2031? That's 10 years. It's interesting because I would say that there's a lot of opportunity in both of these markets. I mean, how can you deny in 10 years that they're going to do well? I would say the challenge that we face is that basically I did a study a while ago where I looked at the amount of investable companies in a market. And I looked at India, and I looked at China, I looked at Vietnam, and you find that India and Vietnam are very similar. And what are they similar about? What they're similar about is that they both have a small amount of investable companies. About 10% of the companies in these markets are truly investable. That means that they're large and they're liquid. You can get in and out of them. Flip that over to China, and you're going to see just the opposite. 90% of the Chinese companies that are in the market, more than 3,300 companies, are large and liquid. So I would say that for right now, India and Vietnam can be pushed up to really high levels because there's such a small amount of liquidity. My hope is that India and Vietnam can get more liquidity in their markets, and if they can, that'll be fantastic. But when you have a small amount of liquidity in the markets, The problem that you face is that sometimes the markets can go up really, really high. Thailand, in fact, where we are right now, is one of the most liquid markets out there. Now, I do have a question that came in here that says, with the uncertain pandemic situation, what's your view on asset allocation that we should manage for our portfolios? Are you interested in Bitcoin or digital currencies? So, before I answer this question, I just want to say hi to everybody watching. I see that there's more than 600 people watching right now, and I'm happy to have you guys here. If you got any questions, let me know. And if you want me to talk about other topics, I'm happy to do it. But this question that's come in is asked about digital currency, and I'll just talk about it briefly. This is the first thing, is that if we look at the Bitcoin, you can see obviously Bitcoin has gone up from its beginning up by 6 million times, yeah. And so I just wanted to put this Bitcoin in perspective with the other asset classes. So I started Bitcoin, the purple line on this chart, when it had trading volume in 2017, which was about $1 billion US. And that $1 billion US, basically I rebased it at that point in 2017 at 100. And we can see that it's gone up quite dramatically from that time, from 100 up to about 700. And we have tested Bitcoin to try to answer the question, is it a separate asset class, the cryptocurrencies? And the answer to this, I would say, is that in order to be a separate asset class, you have to have low correlation with the other asset classes. Yes, it does. You have to have similar characteristics within the class, meaning that different cryptocurrencies kind of move similarly, not like stocks, as an example. And that existing asset classes cannot produce the same return. That's true. And improvement of risk-adjusted return in your portfolio, that's true. So I've changed my opinion on the cryptos over the last couple of months. And the main thing I would just say about cryptocurrency is that it is potentially a new asset class. And I would say, though, it is a very highly volatile asset class. So if I looked at allocating, it would be somewhere between 0 and probably 3% of a portfolio. Anything more than that, you've got to really be prepared that you could lose it. All right, any other questions that we've got? We've got questions about gold, and maybe I can talk a little bit about gold. We've recently reduced our gold holdings, but how high can the price of gold go? Well, gold surpassed $2,000 per ounce recently, and we saw a lot of people raising their gold targets over that time. And some gold bugs are talking about $5,000 to $25,000 per ounce. And basically, they're all betting on fiat money collapsing, monetary systems collapsing. Now, we can look at the price of gold relative to the S&P 500 and look at the situation. We can look at the 2008 crisis where the red line, the market crashed, and gold basically did well. We can see that gold ended up running up and peaking at 1829. And now we've got this situation where the Fed is pumping money into the system, and that's the green line there. And gold peaked at this point in 2011 in August at 1826. And since then, M2, meaning the money supply, has doubled. And so it's very likely that we would see that gold could go up even to as much as 3,500. Now, I'm not saying now, I'm just saying if we look at some of these past analysis, we could come up with a justification for a relatively high gold price. Now, it's going to take a monetary collapse, basically, or the collapse of the dollar, right? And so that gives you some ideas. So my main point about that, and that is simply that Q&A, or that gold could go up to maybe 3,000 and all that. So now, why don't we switch over to purely Q&A, and I'll start to go through any of the questions that you may have. So let's see. I see we got, okay, you still have a view as your, can you move that screen over? I can't see the, all right. I'm trying to look at the questions, but I can't see it totally. It's blocked. Yeah, just there to the right. Okay, do you still have a view as your view? You told us in Phenomena Live last year that stock market crisis will end in mid-July 2021. Well, I would say a lot's changed since the last time I talked with you, and that's the whole thing about investing. I spend every day of my life thinking about the markets and all this stuff. And I would say at this point, I still feel like there's reality is we're probably going to see some sort of crash in the U.S. market, but I suspect it's going to be even more about the U.S. dollar than the market, because remember, it's the tech companies that have been going up in the U.S., and the other companies actually have been going down. So my feeling is, yes, we probably still can say that there'll be some correction in the market, but I think the correction really to watch out for is the U.S. dollar. All right, other questions? Let's see if we got any other questions here. Keep your questions coming if you've got them. And if I didn't answer your question, you can ask it again. Please give us your opinion in the Thai stock market in 2021. Well, the Thai stock market, I was just looking at the PEs and trying to think about my expectation of the Thai stock market. And I would say right now, if we look globally, we could say the PE across the world is at about 25 times. Price to book is at about roughly 3 times. Thailand's at about 20 times PE and a price to book of about 1.7. Now, I would say that from my perspective, Thailand's not that attractive. If you can allocate your money outside of Thailand right now, I'd probably do it. But I suspect that in the next couple of months, we'll eventually see the Thai stock market starting to get attractive again. But right now, I don't have a strong positive opinion on the Thai market because I see some of the other markets in Asia, particularly China, as potentially more interesting right now. And that's the point of the all-weather strategy also, because you may be an expert in the Thai stock market, you may have your positioning in the Thai stock market, keep that positioning, but if you start to get nervous that the Thai stock market may not produce the returns that you want, then maybe a little allocation to the all-weather type of strategy will allow you to get some exposure outside of Thailand. All right, any other questions? What do you think about increasing of inflation? Will it impact to the stock market in the next 1 to 3 years from now? All right, so basically I think that we will start to see inflation. Right now, nobody believes that because the bond market, the bond yields are so low. When bond yields are low in the US and also in Thailand, as we see, then you could argue that people are not factoring in inflation. If that's the case, then if we got a positive surprise, meaning an increase in inflation, it's going to have a negative impact on the market, and interest rates are going to go up. Now, what's happened is the Fed is afraid of inflation rising, and the result of that is that they've said they're going to keep the interest rates down. Even if inflation starts to rise, they're going to keep interest rates down and let inflation rise a bit. And eventually, I suspect, they'll start to get worried about it. But for right now, what you have is a potential interest rate control situation where the Fed is going to keep interest rates down even while inflation is rising. So I do expect to see inflation happening in the US. And it's not the type of inflation that usually would drive the stock market up. Sometimes when you see inflation, you can say, well, that's good. The economy's growing, things are growing, prices are going up, wages are going up. But the reality is that I think that we're going to see a lot of cost push inflation where things are going to get more expensive, particularly in the US, and then we'll see inflation rising. And that inflation can potentially spread around the world. And let's hope that that brings us back to some more global trade where people are trying to reduce their costs. So yes, I think inflation is going to come back. We may have 3 months or 6 months without any inflation because it's hard for people that have lost their salaries or had their salaries cut, for businesses and all them to increase prices. But I do think that there are some underlying factors that are causing price rise. So inflation rise is something I would expect. All right, next question. Does the reduction of the US dollar use affect the Thai market? Yeah, I mean, ultimately, Thailand is kind of in the middle between China and the US. And as of right now, the US is really the alternative for using the US dollar. So yes, over time, Thailand would be impacted if the US dollar became less of a trading currency. So I think that's a critical thing. Now, there was another question right there. Should we reduce the investment in the US tech company fund? You know, this is a tough one because it's possible under Biden that the tech companies do really well. But I suspect that they've already, number one, they've already done well, right? We've looked at the returns of the US, of the tech companies, and we can see that their returns are very high, not only the returns in their profit, but also in their share price returns. So I would say if you're in tech, you've already gotten some great performance. I wouldn't say that you just cut tech right now because I think it can rise further. But what I would say is I would reduce the position so that you're not heavily overweight tech at this point. Keeping in mind, there's going to be an attack or a counterattack against tech at some point in the US. Already, there was a case that just went against AWS for Amazon, where Parler, the conservative form of Twitter, has filed a antitrust case against them. So it's very possible that they'll get more and more attacked. So I would say longer term, I'm a little bit nervous about tech. All right, we got another question here. Why do you overweight Asia Pacific and globally emerging markets? That's 50% of AWS port. Okay. So it's 50%, it's 25 of the 85, right? So we have 85% allocated to the portfolio and to equity. And these two areas are pretty heavily weighted in the portfolio. So why do we do that? Well, the first reason is because I'm nervous about the US market. It's very expensive, and tech companies have run a lot. So first of all, I want to reduce my exposure to the US market. Second thing is that I don't want to reduce my exposure to equity, because ultimately the strategy of AWS is to maintain equity exposure as much as we can. And so I don't want to go, if I don't like the US, I don't want to reduce everything. And so therefore, the emerging markets and also Asia are the places where I'm comfortable allocating that money. Also keep in mind that emerging markets in Asia are trading on much lower multiples. In fact, you're talking about almost half the level of the multiples, for instance, of the US. So Asia's growing, Asia's not that expensive, and I think it's a great way to stay in the equity market without taking on the risks that we see in the US. All right, other questions. If you've got other questions, feel free to drop them in. Okay, so this is an interesting question. Why does AWS strategy doesn't have REITs, or property or infrastructure in the strategy? Excellent question. The question really is, well, there's 4 asset classes that I'm telling you about. The first one is equity, the second one is bonds, the third one is gold, and the fourth one commodity. You're going to say, well, wait a minute, Andrew, what about real estate? Isn't that a 5th asset class? Yes and no. My answer to this is, first of all, do you own your home? If you own your home, you own real estate. So my first thing is that if we look at your overall portfolio, chances are that's the one asset that the majority of people who are investing have exposure to. So if we were to include your home into the AWS portfolio or any land or other things that you own, you're already going to have exposure to real estate. And what exposure are you getting with that real estate? That exposure is the price increase of your condo or your house. So there's no reason for me to double that position by going into real estate. So second thing that I want to talk about is REITs. So real estate investment trusts are an interesting asset because they are a yielding asset. You can basically invest in one and you're going to get a 3, 4, 5, 6% yield coming from the property. First thing is that remember, for most markets, REITs are already in the market. So you already have REIT exposure in the equity fund that you're investing in because a REIT is part of the equity index. The last thing I would say about REITs is that REITs tend to, when you look at them over a long period of time, they tend to be an asset class that moves very closely with equity. My conclusion is that REITs do not add much value to my overall strategy. The last thing I would say is that it's hard to get a good REIT fund that's a global REIT fund, and therefore I'm not owning REITs. I hope that explains why that is, because I know it's a different analysis on it. All right, other questions? Looks like we have some other questions coming in. Is there a bubble in the US tech stocks? Yes, there is a bubble in the US tech stocks. It's just a matter of how long it can blow up, right? Whenever someone asks me, what is inflation? What I tell them is, inflation is just like when you blow air into a balloon, the balloon inflates. And when a balloon inflates, you could inflate it to a point, but eventually it will pop. And I believe that what's happening right now is the inflation of the tech bubble. But you can think about inflation, about pumping money, not air, into an asset. When the mortgage crisis happened in the U.S. in 2008, a huge part of this was that the U.S. government encouraged and provided funding to millions of people that didn't have access to lower income, let's say lower income, lower credit risk people that were able to get access to loans and then buy houses. You're bringing millions of people into demand with money, and that pushes up prices of real estate, and that's part of the reason why we saw a bubble in 2008. The same thing is happening in education, where the U.S. government is funding education. It's pouring money into the education. So again, it's like blowing up a balloon, but in this case with money. So yes, in my opinion, the tech stocks are in a bubble. It's just a question of how long they can stay there. Now, one difference, when you think about a bubble really is something really high. I would say they're at kind of the beginning or middle point because they are producing fantastic profits. So it's hard to say that it's a huge bubble, but eventually I believe it can pop. All right, another question is, if one has to choose between investing in China versus US tech, what's your guidance? And if China, what sector? Well, okay, so if your choice is China or US tech, that's a tough one. I mean, first of all, tech is, as I'm saying, it's expensive. It's in the middle probably of a bubble. So you may be able to ride it for the next couple of months and do okay. China is different, in the sense that there's so many factors that are involved in China that I would be very careful about buying any particular sector. I would prefer to look at China either by specific companies, or I would look at just a China fund. I wouldn't look at individual sectors. Last thing about China that's important to know is that about 30% of the market capitalization of the Chinese market is financials. Banks are the biggest part. That's 30% of the market. Remember, banks never trade at high PEs. Never. And the PEs of China are no different. In fact, I was just looking at that. If you look at the PE of the Chinese stock market, it's 13 times. Seems cheap. But if you exclude the banks, which I did for this call, for this video, if you exclude the banks, you're going to come up, for instead of 13, it's actually 18 times. So the banks are making the Chinese market look like it's cheap, but it's not as cheap as it looks because, and remember, the banks, it's dangerous. Banks, I don't even invest in banks when I do the portfolios of stocks because I know that banks don't actually add that much value to a portfolio. All right, another question. What do you pick for right now, for cyclicals right now? Financial, energy, or U.S. small cap? Whoa. Great question. I would say not financials. I'm not big on financials, and I think there's a lot of danger there, particularly if things just don't go well. Energy, I find interesting, and I think that you've noticed that I've increased the weighting to 5% commodities, and commodities consist a lot of energy. So I would say that energy is probably one area that I would feel pretty comfortable with building a position in. And then other one is U.S. small cap. I think U.S. small cap is interesting also because any companies that can survive the tsunami that hit in 2020 and they're still listed, they're still making profit, I would say they're probably worth. So small cap value in the U.S. is probably attractive. It's not expensive. So again, that's where the tech giants are really rocketing up. But actually, there is a turnaround happening in the small caps. All right, next question. Next question is, when total asset value of a port is below 5 million baht, high risk port, focus on profit making, what and how much assets you recommend to mitigate overall risks? Okay, so I would say that I'm not sure if I can answer that question because it's a little bit confusing. I'm not exactly sure what that is. So maybe we'll go to the next one and then you see if you can clarify that one. Next question. With the adoption of alternative currencies like Bitcoin, to what extent would it change the way our markets interact? Well, the problem with Bitcoin, I think that cryptocurrencies provide a unique situation where 0 to 3% of your portfolio could go to these cryptocurrencies. But the problem is that I don't necessarily think that the cryptocurrencies are going to replace, let's say, the US dollar. And so I would say that we're probably going to see more of a change in the way we interact with money through government digital currency rather than Bitcoin. Bitcoin will be one way, but I believe that the US government, the Chinese government already are trying to do digital currencies, and I think we will face what we would call a Bretton Woods number 2, where governments get together to try to figure out how to get dependence off of the dollar. All right, next question. Let's see. Yeah, okay. What is your view on cryptocurrency? I would just say 0 to 3% of your portfolio could be allocated to that, and just expect that it's a crazy ride and you're going to lose it all. All right, let's look at this. All right, here's another question. Andrew, you said that Democrats want to handle tech companies on antitrust. Is it possible that these tech companies are Dem sponsors as well? Is it possible they're on the same side? You are right. I believe that the tech companies are on the same side. When I talked about the antitrust case, it was an application called Parler, which is a conservative Twitter. And so it's actually the right, the Republicans, that are fighting back right now against big tech for shutting down their software, shutting down their access, and shutting down Donald Trump. So I think you are right that there's a connection between big tech. You know, if you look back when I was young, growing up in Ohio, I grew up near Cleveland, Ohio, and there's a lot of factories there. The car industry was there. Steel industry was in Pittsburgh. I mean, it was a labor area. And the Democrat Party was the party of the working man and woman. Now the Democrat Party is the party of kind of the Zoom class, the upper middle class, the tech companies, and so they've really changed. In fact, this is why I believe Trump was able to grab the presidency, because the middle class or the working class in America is a lot of people, and they've been struggling because a lot of work went overseas to China. And then the end result of that is that they were left with nothing. Going back to Ohio, where I grew up, they have nothing. It's a lot of drugs, it's a lot of problems, unemployment, no work, no money. It's desperate. And so those guys are basically struggling in the Midwest. And the Democrats abandoned them. In fact, they called them deplorables when Trump was picking them up. And the Republicans never really focused on this working class that was suffering. So they just left these guys out in the middle, and Trump had an opportunity to talk to them, and that's how he got his voters. Something similar happened in Thailand many, many years ago. I notice that we now have 700 people on the line. I want to thank you guys all and say hi to everybody, and keep your questions coming. These are great questions, and you're making my old mind think hard. So let's keep going. Do we have any more questions? All right, let's see. What's another question we got? Hold on. What's your view on the Japanese market? You know, Japan's interesting. Right now, our weighting has come down to just 5% of our overall equity allocation. But I would say that Japan looks interesting to me. There's so many listed companies that are small and medium sized that are not expensive. Some corporate governance getting a little bit better in Japan. So overall, I would say Japan is interesting. And if you're a stock picker, let's go looking for stocks in Japan. I think there's a lot of opportunities there. All right, next question. Do you think the new president will bring about economic decline in the US and likely to move more stronger dollar or devaluation? Okay, so I think that when it comes to Biden in power, of course, we all know it's not going to be Biden in power. His condition is not that strong. And it's probably not going to be Kamala Harris either, because you could say she doesn't have a strong opinion about international relations, about economics and all that. So I would say that what's going to happen with Biden coming in is that the old guard, the old State Department, the old Treasury Department people are going to be coming back, and we're going to get back to the same things that we had in the past. And in my opinion, some of that is, you know, problematic. Getting back to war, getting back to putting pressure on countries, getting back to trying to go against Russia as hard as possible. So I think, number one, we're going to see the same old policies are going to come back. The second thing that I would say is that we're probably going to see more printing of money and more money being handed out, though it's hard to say that because, remember, we have a very narrow majority that the Democrats have. So it's not like Biden has a great majority to do a lot. Unlike, let's say, when Trump or Obama first came in, they had majorities. And in fact, it's quite possible that what the Democrat Party together with the tech companies are doing right now 2 years from now, we're going to have another election in the House every 2 years. And when that election comes, it could swing the House back into the control of the Republicans. So I would just say that I do expect more disruption in the world, and also I think ultimately the dollar decline will be significant under the Biden administration. All right, unrelated to an extent, but what is your view on markets being disconnected from the real economy? Okay, so basically you can say that stock markets are not connected with the real economy. A great example that can prove this right off the bat is China. If we go back in time over the last 25 years or so since the Chinese stock market started opening, and we were to compare the growth in GDP, we were talking about nominal growth in GDP of about 15% over that time. But that wasn't the growth in the stock market that you got. It was a much wilder ride and a much lower return. So generally, the stock market and the economy are disconnected to a certain extent. Even over the long run, look at China. It's an example of how disconnected they are. Also remember, the difference is that what the economy is linked to in relation to the market is the earnings of the company. But the extra component in the market is the share price and the speculation. And it's that speculation that's happening all the time in the market that brings the market up to extreme positive and down to extreme negative. It's this speculation that makes the market react so much different from the economy. So I would say they are disconnected. All right, many research said that emerging markets will get benefit this year. What's your opinion? I think so. I think the US is going to struggle, and I think that, you know, one of the things that's really fascinating is when you get a crisis, every crisis that we've seen, for instance, in Thailand, you always get depressed and the market goes down and it seems like a crash. But what happens is that the biggest companies always end up coming out of it with more profit. They come out of a crisis with more profit. I think that one of the things that you're seeing, whether it's in the US, but also in emerging markets, is that the companies that survive are in fact coming out with very strong profits. So I think it's also dangerous to say, well, I think the US tech companies are really expensive, therefore I don't want any exposure to the stock market. The small cap companies, the value stocks in the US as well as in Asia are to me still interesting. Now remember, I don't do a lot of value versus growth allocation in the portfolio, and so therefore I'm not going to play that game too much. But all right, we got another one. Can you give your opinions about what's the risk when you invest on cloud services, technologies, and e-commerce ETF fund? Well, I think, you know, if you invest in this type of ETF fund that is in fact investing in, let's say, the wave of the future, you know, the cloud services and these types of things, the good news is that you're riding the wave of the future. The bad news is that you're riding the wave of the future, and sometimes it can be pushed up to a really high valuation level and then you're stuck. So a little bit like the question about the e-sport ETF, I would say be careful, only allocate a small amount of your assets to any one sector, because if that goes wrong, you know, it can really hurt. All right, next question. What's your view on Chinese tech companies, especially on Chinese government regulation and trade war with the US? Well, clearly, we now have two tech platforms in the world, the US and China. Now, for those of you that use, as I do, we use WeChat on our mobile phones, we're using Chinese infrastructure. And the problem with Chinese infrastructure is that when it comes into the English language and all that, it's a lot more not as smooth as when the US companies are presenting in English language naturally. But I definitely think we're going to see these two groups building up against each other. And so I think that's what's happening in particular when it comes to China and the US. I think also the pressure that the US government is putting on countries because they control the US dollar market, the pressure that they're putting on companies, I would say, is going to cause China and Russia to continue to work together to be the foundation of a new monetary grouping. And it may not become the monetary grouping of the whole world, but for this region of the world, I think it's very possible that it does. All right, any other questions? What do we got? Would your asset allocation suggestion applicable for older investors as well? Should near retirement investors partially reduce equity weight in the portfolio? Yeah. I showed you a picture at the beginning of this presentation of my mother. My mom and my dad invested very carefully over the years, and you know, she's in a good position right now. But it would be crazy to have my mom allocate the majority of her money to equity market because she couldn't bear a massive drop in the equity market. And if she actually lost her money, she doesn't have the ability to gain it back, unlike a young person like myself. So the point is it's a great question, and I think it's an important question to note. The all-weather strategy is trying to kind of maximize return and minimize losses. But if you're over 60 or 70 and you don't have a lot of money, I would say it's not perfectly suited for you. You may just put a small allocation into it, and then the other part is in maybe safer like bonds or something like that. So a portion maybe, but not all. All right. What about clean energy theme for 2021? Well, I think that clean energy is going to be a constant theme going on. The challenge is how do you play it? You could argue that many people are playing it through Tesla right now, but we need more and more companies that we can buy that allow us to play it. So I don't have a great answer to that, but I would say if you're interested in clean tech, it is an asset class that should have a good future. What's the asset class to overweight, neutral, and underweight this year in your view? So I would say right now I'm overweight equity, underweight gold, underweight bonds, underweight commodity. That's where I am right now. But if you say this year, that's my positioning at the beginning of the year. I think that my positioning will start to come down on equity once we see the US market starting to get weak. And so that is a risk. So if I had to break it down, I would say something like, if you said, what should I set up right now for the rest of the year? Maybe you're talking about 60% equity, 20% bonds, 10% gold, something like that. What do you think about the China fund if I would like to choose investing in it? I haven't looked at the specific China fund, so I can't tell you about that one, although if I got more information, I could look into it. But generally, if I look at building a position in China, it's probably better to go with a broad-based China fund than to try to pick a sector in China. Of course, if you could get a broad-based China fund that doesn't include financial companies, I think that's an advantage, but I don't believe that it's available. Okay, next question. Between China fund and Asia ex Japan, which one is your preference? I would say Asia ex Japan. The reason why I would choose Asia ex Japan over China is because China is a portion of Asia ex Japan, mainly through Hong Kong. So you will get some Chinese exposure by owning Asia ex Japan. The second thing is that you got to keep in mind that China is a very volatile market. So just allocating only to China can be a bit dangerous, whereas allocating to Asia ex Japan, you're diversified across the different Asian markets, and I would say that would give you a relatively good opportunity. So next question, how about financial sector in both global and US market? Again, I'm hesitant about financial sector because I don't see that there's an entrepreneurial spirit. It's a commodity business. That's the first thing. The second thing I would say is that the banks and the financial companies are more and more just a tool of the government these days, and they have to do what the government says or else. So they're really a regulated business. So I'm not that interested in them, but you could say that there's a turnaround coming, and when it comes, you can grab that and earn a little bit, but I'm not that interested in it. What's the level of risk of foreign funds outflowing from Asian markets? Well, I think this is an important question because if foreign funds come out of Asian markets, it's going to cause Asian markets to fall and deflate relative, let's say, to the US. What could cause that is if America disturbs the Middle East, as an example. They pick up the rhetoric, in Afghanistan as another example, and if they do this, then we could see that there could be a flight back to the US dollar and back to safety, and if that happened, it would definitely hurt the Asian market. So we have to watch for that. All right, next question. More on Chinese equity strategies between active and passive. I think I'm going to answer that one because I don't understand that other one. So is there something more with that question there? No. All right. So let's look at this. Active or passive for China funds, exposure to which sector, are Chinese tech overvalued, as in the case of the US? So the challenge with Chinese funds is that you're asking between active and passive. I'd have to really look at those funds to look at it, but there's not a lot of passive funds that I see for China. For me, I would prefer a passive fund for China because I just think it's really a complex market, and it's just also political things can happen that can hit particular sectors and the like. So I would say passive if you're sitting in Thailand and you don't know much about China. As far as Chinese tech companies being overvalued, I would say yes, somewhat, probably not as much as the US, but they are making a lot of money. The genome theme, man, you are far ahead of me on that. I don't know much about the genome theme, so I don't have an opinion on that. Any other questions? Let's see, other questions? Yeah, I don't know about that one. Let's keep going. I'm thinking and still thinking about investing in the funds, but it looks like lots of funds seem to be just jump up very high in December. Should I wait and see or jump into something else? Okay, so yes, it is the fact that some funds have jumped up at the end of December. For your case, why not take the money you're thinking about allocating to funds? Let's say it's $1 million baht. Why not divide it into 5 pieces, 200,000 each, and then put that money in over time, like dollar cost average it over 5, 6, 7 months, with your objective being that you're going to get into it kind of slowly, rather than just jumping all in. The problem that you face with jumping all in is that you could see your money fall quite substantially if the market crashes. And that's why I tend to prefer doing it on a little by little basis. So that would be my advice. Be careful, because when you say jump head on in, it usually means that you are potentially being drawn in by the tantalizing nature of greed and fear. All right, I think we're almost at the end, so let's see what should be the gold price that we should start collecting. I feel like gold right now is not that expensive. I don't have a specific target price, but again, a little bit like the dollar cost averaging concept, I would say put a little bit in over time, a little bit in. I think from a longer term perspective, gold is relatively, I wouldn't say cheap, but I would say I think there's more upside to it. So I would build a steady, slow position in it. Next question, in which country do you own within share view about China's market liquidity that seems to decrease? Okay, I see. Okay, which countries in emerging markets would you overweight, underweight? Right now, I'm overweighting a little bit, a little bit of Indonesia and a little bit of India right now. But I would have to think a little bit more before I answer that question about overweight, underweight in emerging markets. There was also another thing that Chinese liquidity decreased. Yeah, the problem you're going to face with any market in China is one where you can see things reduce because of government action or something like that. But even when liquidity falls in China, it's still a very liquid market, particularly if you're a small investor trying to get in and out with a small amount of money. I wouldn't worry too much about that. For this year, next question, do we move to invest in emerging markets and small caps? Thanks. Yeah, I would say that that's probably a relatively safe bet. All right, so we got another question. Top 3 countries in emerging markets that have good growth potential in this year and afterwards, and why did you pick it? Whoa, you asked me a detailed question. Right now, I would say in the emerging markets, I think Indonesia looks interesting to me. Philippines a little bit, Thailand a bit. I would say that those are kind of the ones that I'm looking at. You could also say a little bit of Malaysia. I guess what I'm saying is that I'm probably more into Southeast Asia emerging markets than other parts of the world emerging markets. Also remember, I talked about the fact that emerging markets are less correlated with the US market. So if the US market did start to fall, then what we would see is that the emerging markets would fall less than if you were exposed somewhere else. All right, what's your view about healthcare? And will there be a policy from Biden that will hurt healthcare sector? I think that Biden will try to go back to Obamacare, but remember, he doesn't have a big majority of control in the House and in the Senate. And as a result, it may be hard for him to pass the Obamacare and get that going again. And remember, the Democrat Party voted for the last bailouts that happened, and those bailouts that happened during the COVID time basically were not bailing out individuals and their health situation, they were bailing out big companies. And so I would argue that, I doubt that the Democrat Party is going to be able to do much in the space of healthcare reform. What's your view on Europe and Japan market? And as there's outlook in 2020 released earlier negative, on these two markets. Yeah, I would say I'm interested in I'm probably more interested in Japan than I am on Europe, just because, it's hard to say that Europe is going to have a strong recovery. It's just been a hard time getting through this crisis for Europe, and also European banks, I would say, are at risk. Next question, what's your opinion about climate change and equity? I'm not sure if I can answer that. I mean, obviously, we like to see good ESG at the funds, but I'm not sure if I have an answer. Another question, what level of risk of foreign funds outflowing from Asia, and what could be the possible causes? Okay, so this one I answered before, and it was really the idea that a destabilization around the world of, let's say, the Middle East or other places could cause the money to come flowing out of emerging markets, and that would be definitely a risk. All right, here's someone saying, my equity allocation is US tech 40%, China tech 15%, China A shares 25%, and ESG theme 20%. Do you think this allocation is going to perform well for long-term investment? No. No, I don't think that's going to perform well for long-term investment. Why? Because you're so narrowly focused on tech only. If we go back to that, just so I can get the numbers right, can you go back to that one? So 40% US tech, that's a massive weight of equity, of your equity allocation into one sector. Then you add on 15% into China tech, and now you're really, almost 50% of your equity allocation is in tech. What if tech goes wrong? I think that could be a risk. As far as A shares are concerned, I think from a longer term perspective, you're probably okay. There's going to be a lot of ups and downs because it's a very volatile market, but I think that over time, A shares should be okay. And ESG thing, I think you're okay. So the only thing I would say is that your tech exposure, to me, seems to be a little bit high. So if it was me, I would say trim a little bit of that, particularly the US tech, from 40 down, and then allocate that maybe to small cap, to to industrials or companies that are starting to come out of the crisis. Yeah, can you give your opinion about the risks when investing in ARK fund? Actually, I don't know much about ARK fund, so I can't say I have an answer for that one. I know, let's say there's some other ones like Grayscale and all that. Grayscale is one way of trying to buy exposure to cryptocurrencies. It's a little bit of an expensive fund, but if it gives you exposure, it could be that it's valuable. So I would look more deeply at Grayscale, but look at the cost of that fund. Just be careful. Next question, what is your view on Genome? Actually, I don't know enough about Genome to give you a reliable answer. What's your opinion about investing in U.S. and global financial sector? I would avoid financial sector, in my opinion. It is going to have rallies at time and very liquid and all that. And so basically, I would say just be careful with financials. So we have a lot more questions left. Unfortunately, I'm being told that our time is up. I want to thank everybody for attending, and I really want to thank you for the questions that you have. You challenge me to think more about the markets. I've got more work to do, and I hope that we can get together again sometime soon to try to go through these questions. I'll also try to go through more questions that you've posted in the comments to see if I can start to address some of these questions. So again, I want to thank you all for paying attention and listening and providing such great feedback during the presentation, and I'll see you next time. This is Andrew Stotz signing off.